The debt conversation is a disturbing one. There's the debt levels. There's even the U.S. deficit levels that we're running this year. There's the fact that the Fed's buying, I think, more than half of new Treasury issuance already. How's this all going to end?
Well, let me first say it's absolutely necessary to take on the deficits and debt right now, because if we don't, the economy, which is in your previous segment you were talking about, is struggling. It'll evaporate, and our fiscal problems even more significant. So really, it's a Hobson's choice. There's really no good choice. The least bad choice is what we're doing, and that is supporting the economy. So we need more additional fiscal support. But as economists are wont to say, there's no such thing as a free lunch. So on the other side of the pandemic, down the road, when the economy is hopefully approaching full employment again, interest rates are starting to rise, these high debt levels are going to be an issue, particularly for businesses, corporations. They've been borrowing very, very aggressively, particularly already highly levered businesses. And I think that will be a fault line down the road in the economy.
Right. And Mark, this tally includes not just government debt, but corporate debt and other types?
Yeah, it's the whole shooting match. So sovereign debt, government debt, so here in the U.S., Treasury debt, corporate debt, what businesses are out there borrowing to help navigate through the pandemic. Obviously their sales and cash flow in many cases have been disrupted, and they need more debt to continue to manage through, and also household debt. Good news there, at least in the case of the United States, household debt is not an issue. Since the financial crisis, households, at least in aggregate, have been very prudent in their borrowing, and even today, the growth in their debt levels is less than the growth in their incomes. So I'm not worried about that. I'm really worried mostly about corporate debt, and then secondarily, obviously, the growing deficits and debt at the federal government level.
On the corporate debt piece of this, the most obvious sort of macro impact that I can see is that as companies earn more money in the years ahead, they're going to have to divert it to paying down debt instead of investing and kind of boosting profits and productivity that way. It's a subtle effect, but I don't see how it could be avoided.
Yeah, it may not be that subtle. I mean, if you get into down the road and we get into another economic problem, growth slows, then these companies are going to have some pretty difficult choices to make. Do I make my debt payment, or do I cut payrolls and cut investment? So the high debt loads could, in fact, exacerbate future economic downturn. It really hasn't been an issue in this go around, only because of the extraordinarily low interest rate. So it's been basically free money, and that's really taken a lot of pressure off. But it's helped to exacerbate the increase in debt that we're seeing. But it's really down the road, perhaps in the next business cycle, where I think corporate debt will be more of an issue. You may remember, Kelly, before the pandemic hit, there was a lot of hand-wringing about so-called leveraged lending. That's lending to businesses that are already highly indebted. That problem hasn't gone away. That problem's worse today than it was. But it's not a here and now problem. It's a problem in the future when interest rates do rise. That's when we're going to be struggling with this.
And Mark, finally, on the government debt side of this, there's completely new philosophies, modern monetary theory among others, that would suggest our concern about these levels is way overblown. And certainly we know from the experience of the past decade or so that there's no tipping point that we've yet reached on this front, despite all of the warnings, the concern that we've had, Tea Party movements, political response, you name it. Our bond yields keep falling and do so no matter kind of how much we're issuing. So I guess to me, it seems like the only thing that could happen, other than perhaps another political response, is at some point the bond market pushes back. And until or unless that happens, off we go.
Yeah, I think you got that right. I mean, in the here and now, we have very high unemployment, underemployment. We have very low inflation, well below the Fed's 2% target. And most importantly, the Federal Reserve is telling us that they're going to maintain zero interest rates until we're back to full employment. So in that context, the appropriate policy is deficit-financed fiscal policy. We need another fiscal rescue package to help the economy navigate through the pandemic. Because, again, if we don't do that, we will get into that double dip you were talking about, and our fiscal problems will be immeasurably worse. So we have to do this. But on the other side, there is a limit, and we are going to see that limit. By the way, we're borrowing here heavily in the United States. Every economy on the planet is doing the same thing. So I assure you, down the road, 2, 3, 4 years from now, global investors are going to say, what's going on? Am I going to get repaid in a timely way? And the answer is probably not, and interest rates are going to rise.
Shepard Smith here. Thanks for watching CNBC on YouTube.